Good. And I just have to stop about 55 minutes in and 5 minutes before the hour. Yeah.
Cool. All right, we're live. Welcome back. This show is brought to you by the BitBox O2 Bitcoin only hardware wallet. If you're buying Bitcoin, that is an excellent move for your future self. But as we all know, not your keys, not your coins. The best way to own Bitcoin, in fact, the only way perhaps, is to take custody of your Bitcoin, and a hardware wallet is a convenient and easy way to do that. I've been really impressed with the BitBox and the set of features that they deploy in the device. If you want to learn more, go to shiftcrypto.ch/rapid fire for 5% off. And we're also brought to you by the Bitcoin 2021 conference, which Caitlin and I were just talking about. Caitlin's actually going to be a speaker at the conference, which is super exciting, with some other Avanti peeps. And I think this is going to be such a fun time. It's going to be so great to meet everyone, to hang out, to maybe even get a little messy after the conference, formalities are taken care of. So if you're interested in learning more or going, go to b.tc and use the promo code VALIS for 15% off. Caitlin, how are you?
Hey there. I'm doing great. Thanks. I can't wait for that conference. I'm so pumped that we're all actually going to be able to get together in person again. And most people are actually showing up in person. It's like you said, there's so much pent up energy, and it's just overdue. And a lot of folks, I think, are going to have a lot of fun. Yeah,
a lot of people jumping through a lot of hoops to get there and return home, and quarantine still in various places. So I think they're going to try to maximize the benefit of doing so. Caitlin, I've been, really excited for this conversation. You've been doing so much in this space, both publicly and behind the scenes, for a long time now. I know we have only an hour, so we're going to have to move through a lot of territory quickly. But just for those people that aren't familiar with you, maybe a bit of background as to your education career and kind of how you wound up in this spot that you're in now.
Oh gosh, born and raised in Wyoming, which is the Wyoming connection. Never left truly, but I spent almost 3 decades on the East Coast between going to graduate school at Harvard, got a law degree and a master's of public policy there, and then went straight to Wall Street and spent the bulk of that 3 decades working in the belly of the beast, so to speak, right in the middle of Wall Street. Did a number, basically started 3 new businesses on Wall Street. Really got into the weeds of how the plumbing, the back of the bank, so to speak, really works in the U.S. dollar financial system, as well as in the securities settlement system. And I saw a lot of problems, some nefarious, some not. Mostly just bad system design. And so when Bitcoin came along, I had also done a lot of, gone down the rabbit hole of after the financial crisis of figuring out what really went wrong in the financial system, because it didn't. I heard Treasury Secretary Timothy Geithner give 2 interviews that seemed to contradict themselves a couple weeks apart. One was that he said, yes, interest rates had been too low going into the financial crisis, and that helped create the mortgage market bubble. But then he argued a couple weeks later that interest rates needed to be dropped. And I didn't understand how to square that circle. And so it got me really digging into alternative schools of economic thought. Really, did a lot of reading on everything in the spectrum, from the MMTers, modern monetary theory, which is the craze of the day, all the way to the opposite end of the spectrum, the Austrian school. And through those alternative economic circles, started reading about Bitcoin in 2012. And so, like so many people, I did not think that it was going to amount to what it has amounted to. I thought it had the potential to, but that wasn't the default likely scenario back then. But what I really understood, because I was so in the weeds on settlement risk in the traditional financial system, I understood that this was a whole new settlement system. And so that's maybe the angle. Yeah, the alternative economics brought me to it. But what made me really grab onto it was, this is a better settlement system for exchanging financial assets than what we have now. Yeah,
I think you could, sometimes I think of it as one of the reasons why we've become so hyper financialized, where is out of a desire to avoid settling, because we know there's not really anything to settle back to, or at least there's not enough to settle back to represent what's being constructed in the higher layers. So we have this massive hyper financialized cloud that's not, that there's an anxiety about settling back to anything.
Well, and what I discovered when I was working on a pension transaction for a very large client was we asked for settlement, in other words, for delivery of the actual asset that had to happen the next day. And this was those assets were in a pension fund's locked down account. What do I mean by that? It was in a trust account, segregated from all the other assets of the custody bank. And the custody bank was prohibited from lending those securities. And guess what? When the pension fund gave the custody bank instructions to deliver those assets the next day, the custody bank had to admit it didn't have them because it had lent them out anyway. And so that really got me going. Like, I think that happened in 2000. That was 2012. No, it was a little later. It was like 2013 probably. But anyway, long story short, I keep in mind, I had discovered Bitcoin. Well, I learned about Bitcoin in 2013 or 2012, started buying it in 2013. So to set the table, I'm discovering all these settlement system issues at the same time I'm seeing Bitcoin and realizing, holy cow, this is actually a really good solution to some of those problems. But to your point, if you ever actually have to settle, you realize that John Kenneth Galbraith referred to it as the bezel. There's a bezel out there because we don't like to settle. We just like to constantly net balances against each other, and we're never actually getting real delivery of the real underlying asset. And on the rare occasions when you do, when there's like a merger that has to close and you have to deliver the assets on that day, or these pension transactions, you had to deliver the actual assets on that day. That's when you realize that the assets might not all actually be there. And I had to learn the hard way at that time because the pension fund manager was looking at the brokerage account on his screen, and it was showing that the assets were there, and it was just it was incredulous. How is it possible these assets are not there? That they're on my screen. You quickly realize your account balance at your broker dealer or your bank just tells you what the broker dealer or the bank actually owes you. It doesn't mean they have it. Yeah. So it doesn't mean that they can deliver it if you need it to be delivered.
Yeah, and I think you mentioned modern monetary theory. I mean, we've basically been operating under that philosophy for several decades now. I think the formalization of the philosophy is just trying to conjure up a justification for what's going on. We're looking at it and we're saying, well, how can we, in an environment where maybe if the premise is you don't really need to settle, or that we can continue to kick the settlement can down the road and down the road and down the road, then you have a lot more latitude for making up a lot of these things and acting like there's no consequences to these activities. Sure.
I'm not sure that economic theory is very, very focused on settlement per se. But it just comes back to the bigger question of property rights. Do you have a property right in your financial asset, or is your financial asset just an IOU, which is a contractual right? And it has very different implications in the law when you have you have legal title to something as opposed to when somebody just owes it to you. Very different. You want outright legal title. And I like to talk about the state of Wyoming. One of the questions that keeps coming up is, why Wyoming? Why, of all places, why Wyoming? Well, one of the reasons is Wyoming really gets at a visceral level this whole property rights question, because Wyoming fought what was a de facto civil war over this very issue. It's called the Johnson County Cattle War in the 1880s into the early 1890s. That was in Wyoming, and the war was fought over the fencing of the West. Did landowners have the right to fence out trespassers? And if they do, then they have property rights that are enforceable. And if they don't, then nobody has property rights. If you can't fence out a trespasser, what does it mean to own the land? And I think that is exactly the question that's asked regarding settlement. And I think, a lot of these systems were set up this way out of technological necessity. Keep in mind, everything used to be done in paper. And so you literally had to move paper around. There was the great Wall Street paperwork crisis in the early 1970s, and the New York Stock Exchange closed on Wednesday afternoons just to allow the clerks to keep up with settlement. You had to move the actual stock certificates around. That's why all the back then all the brokerage firms were right next to the New York Stock Exchange, and they physically moved the stock certificates around. And then, then came, we started to digitize things. And you can look at it in the evolution of the law as well. You used to have direct title. Technically, you still do have direct title if you own your stock certificate, or certainly if you own the paper dollar bill in your wallet. You've got outright title to that. You have a property right in that. But the problem is that we started to move in the first commercial law update said, okay, we want to dematerialize these stock certificates. So we don't want people to actually have to have paper. We want to start actually just moving ledger balances, which is so much easier than moving the actual paper. And so that's how all this netting stuff started. So let's move the ledger balances. And so the first update to Wyoming, or to America's commercial law for securities said, okay, you still have a property right in your securities, but you don't have to actually have the piece of paper anymore. The property right is evidenced by the book entry on the issuer's books and records. So back then, think about it, the issuers of securities knew who exactly their shareholders were. I'll come back to that in a second. And then in 1994 was what I've called the greatest theft of property rights in human history, because the entire US stock market switched over from being a direct property right, where you had a property right as long as you were listed on the books and records, you had legal title to the shares. And instead we went to this IOU method where it's indirect. The legal title of securities belongs with the depository trust company, and you are 2 or 3 levels down in your broker dealer away from where that legal title is. And at each of those levels is an IOU. So what you own is an IOU. You no longer have a direct property right in your securities. And that is when things started to go haywire in Wall Street systems. And that's how you end up with like the GameStops of the world. So these market structure decisions were done because of technological limitations of moving from paper, from analog to digital. Well, we're moving from analog to digital to Web 3.0 now. We're not talking about just a PDF copy of things. We're not talking about just an Excel spreadsheet ledger balance moving. We're actually talking about you can have a direct ownership in the actual asset again. And so we're coming back full circle to where we started, which is where we should end up, which is that people should have property rights in these assets. And that's really, it's all about settlement. That's where we're headed, that you know that when you transact in these assets, you actually have settled the transaction, and you're not waiting for layers of intermediaries whose systems don't update simultaneously, which is how you end up with the GameStop type situations. And to your point, until you actually settle something, you don't really know that it's there.
Right. Yeah. And, this, of course, is what's so radical about Bitcoin. It's almost like the archetypal form of a property right, because you could say, yes, you can fence your land and you can have the state enforce that. But if you yourself can't enforce a property right, you're dependent on others to enforce it, right? So it's almost like you can't really own anything in the physical realm because someone with greater force can basically take it to you. Whereas Bitcoin, obviously, you can own it, you can verify it, you can don't
memorize your seed.
Exactly. So I mean, we're really talking about such a a collision of different entities, really. We have this hyper financialized system that is afraid to settle, and we have this thing that if you use it to its maximum effect, it's pure settlement, it's pure property right. And seeing those two worlds collide, and we'll get into this in a second with what you're doing, but seeing those two worlds collide, I mean, it's such an interesting time to see the pressure that each is exerting on the other, and to see the flow of capital from one into another. I mean, it's tremendous. I do want to ask you though, a lot of times people's Bitcoin origin story, it's almost like all the different experiences in your prior life that kind of led you to seeing what Bitcoin was when you encountered it, even if it required a few touch points. You come from Wyoming, where you have this legacy of independence, of individualism, of property rights, right? You come from a financial background, you come from a legal education. Like, were you leaning toward that sort of philosophy of libertarianism, let's say, or individualism or that kind of stuff prior to getting into Bitcoin? Or was it purely your investigation of the '08 financial crisis that kind of allowed you to see the importance of those things?
Yeah, it was the latter. Keep in mind, I actually have a degree from the Kennedy School of Government at Harvard, right? So that kind of tells you a little bit of the background, right? Let's put it this way: I don't think there are any libertarians who have degrees from the Kennedy School of Government.
Probably not.
But yeah, I mean, the financial crisis was really what did it for me, and I just got very, very curious and started reading. It was a client of mine, a very successful hedge fund client. Who I remember I was sitting on the Morgan Stanley trading floor in the height of the financial crisis, and everybody was just talking to people, trying to figure out what the heck was going on. And I remember, he said, "You got to start reading. Just start reading." Well, the question I asked him was, "I got to learn how the Fed works. I got to really understand the mechanics and the plumbing of the Fed." Because it's so funny. You're in the middle of I worked on the trading floor at Morgan Stanley. You would think that you would know all those details. But what happens in the financial system is that people get very narrow and very deep in their expertise. And there is not a lot of breadth. There are not a lot of people who have moved around, and that's another. I'm somebody who's just a naturally curious person and gets bored pretty easily. So I had a very non-traditional path on Wall Street. Started in investment banking, then did equity research, and then started these 3 new businesses. And in 22 years, to do 5 different jobs at Wall Street firms is just unheard of. So I had a very non-traditional path because I just am bored and curious. And anyway, so I had never, the point of this is I had never actually really understood how the plumbing worked. I was 16 years on Wall Street before I started to get really curious about the plumbing, because the plumbing was always somebody else's job. Right. And, as long as the money moved, you didn't have to go in and try to figure out what went wrong. But once I actually then got curious about the plumbing and then started to, it was that deep dive I did on the alternative schools of economic thought in that 2008 to 10 period that really got me, it helped me figure out this business idea for how we were going to transfer pension obligations out of pension funds and into life insurance companies. And actually make everyone better off by doing so. And that turned into a whole new business. But that was the business that I was talking about, where I discovered all the settlement problems. Without going too much into the weeds, I think I can make this digestible for your listeners. Back then, stocks traded settled 3 days after the trade date, or so-called T+3 settlement. And so what happened to try to move pension fund obligations out of the regulatory regime called ERISA into the life insurance company's regulatory regime, which is governed by something called NAIC. We had to figure out, at bottom, the observation was really simple. These are all annuity obligations. You just call it a pension fund when it's in a pension plan, and you call it an annuity when it's in a life insurance company, but it's really the same thing. It's just an obligation to pay cash flows to the obligor for as long as the person's alive. It's the same economic risk. Okay, so the regulatory requirements, though, were very different. And the assets backing those obligations were very different based upon whether they were inside a pension fund or whether they're inside a life insurance company. So what we had to do was figure out how the corporation could settle the pension obligations fairly by buying annuities for the pensioners and overfunding the pension fund. So you're going from a very underfunded pension fund in the pension world to an overfunded annuity in the life insurance world, because life insurance companies are required to hold dollar for dollar assets against their obligations and to hold capital on top of that, right? And they have very, very specific regulatory guidelines on what the type of assets they can invest in. So now let's come back to, all right, we're moving securities that settle 3 days after the trade date, but under the pension rules, we had to do everything same day. So how do you square that circle? How do you take something that settles 3 days later and make it settle same day? That was a very basic question. And that's, again, like, I got into the weeds on all this settlement stuff, figured out how to do that. We actually spend months practicing for the closing date of these transactions, because what happened is, if even a single asset had not made it from the pension fund to the insurance company, then the whole transaction would have failed on both sides, because the pension fund would have been out of compliance with its rules, and an insurance company by law cannot write a contract unless it's fully funded up front on day one. So if some of the assets we were transferring didn't make it over, the life insurance, the annuity contract would have been invalid, and all the assets would have had to have come back same day. What a mess. And you're talking about $29 billion worth of assets. So that just gives you a little bit more color. I haven't talked about this in a podcast in the depth that I just did, but it gives you a little bit more color of the problems we were trying to solve. And again, hopefully it gives you some context for the deeper I got in these weeds of how do you do that? Boy, Bitcoin looked pretty darn good. And I understood, this thing was going to have a big impact eventually if it took off. But back then, I got to say, I didn't talk about Bitcoin very much, unless I was at meetups or conferences, which I did after hours and on the weekends. I didn't pop my head up at Morgan Stanley right away and say, hey, I'm interested in Bitcoin, because when Jamie Dimon a few years ago said he would fire anyone who was involved with Bitcoin, I had that feeling, and most of us Wall Streeters who were into Bitcoin in those early years had that same feeling too. I was looking at some pictures the other day. I was at the send-off dinner for Charlie Shrem the night before he went off to jail to serve his term for the unregistered securities offering. That was, I think, 2013 maybe. Anyway, and I was keeping my head down because I didn't want to be in any pictures, because I was at Morgan Stanley at the time and figured I might get fired for being involved with Bitcoin.
Well, it was probably more rare at the time, and certainly the stigma was worse at that time. But I like to think of all these sound money sleeper cell sound money advocates all over the world, just operating within the machine and waiting for their moment to either jump ship or foster some change from within. But, as you're saying all this, I just think, my God, the inefficiencies that exist in the system now, the reliance on trust, the role and the impediment, and I know you could make a case, there's obviously a case to be made for some benefit from them, but just the influence of the regulators, how much they shape and structure what happens, and whether good or bad, how much that slows down and how much that impedes the efficiency of what actually takes place. I mean, and then, of course, we think of a system like Bitcoin and we think, oh my God, this is the complete opposite. This is an open network where nobody can really impose that kind of stuff. And how much more efficient, fast, cater to customer demands, all that kind of stuff it's going to be. Yes, it's more, sink or swim, right? Like you don't have built-in protections in a system like that. But I think a lot of us would say, well, that's good. And then it implies that you have to take more responsibility as an investor, as a consumer, as a fiduciary, as somebody in the space, right?
Well, yeah. And someone approached me about speaking out about a lawsuit. I'll keep the details confidential, but it's a lawsuit of somebody who lost money in a coin lending situation, sued the coin lender and lost at the trial court, and is trying to appeal and wants me to get involved. And as I was reading through the materials that they sent me, I'm always interested in the legal side of this industry, because one of the things, to your point, is a lot of people just generally have just been caveat emptor. If I lose money in this, it's my own fault. I know there's a lot of risk. But what's starting to happen is you're starting to see people who really aren't thinking of the world that way. And there's a lot more money involved now. And so you are starting to see litigation. This is one of the things that Trace Mayer rightfully observed. He was thinking, 4 or 5 steps ahead of everybody else. What are going to be the attack vectors on Bitcoin as the price goes up a lot? They're going to be very different than the attack vectors today. And one of the attack vectors is lawyers. And so how do we make sure that that lawsuits don't come in and start screwing up but nobody will ever screw up with Bitcoin, the base layer protocol. Nobody will ever screw up that. But where things are going to start to have an impact is in these intermediaries, right? This person was suing a coin lending company. There's been litigation. I'm thinking about the Coinbase litigation over Bitcoin Cash. What was Coinbase's obligation to customers for forks and airdrops? And is it fair that they say those forks and airdrops are not don't belong to the customer? How do you sort that out? right? And so that's one of the things that we did in Wyoming with the digital asset custody rules. We got together with several CTOs in the industry and a consumer advocate and hashed it out. And there were real arguments over what is what is fair, what's the appropriate way to handle this. And I kept saying, guys, it's not appropriate that the intermediary gets to own all those fork and airdrop proceeds and pocket them. If the intermediary claims the forks and airdrops, then that belongs to the customer. But you don't want to spam the intermediary either. So you have to make sure that the intermediary has the ability to say, no, we're not claiming that fork and airdrop, that was not secure. We're not risking exposing the private keys to which they're connected, because the private keys are securing the real stuff. And so we're not claiming those forks and airdrops. But so the right conclusion is, and we split the hairs pretty clearly in Wyoming on what all this means. Do you actually, if you're going to, first of all, the basic conclusion is, in Wyoming, if an intermediary claims a fork and airdrop, it belongs to the customer, period. But and of course, they're not forced into it. They can choose not to claim it. And if they don't claim it, they don't have to be forced by their customer to claim it, which is what the litigation in the Coinbase situation was. Somebody wanted Coinbase to go get the Bcash before Coinbase's engineers had determined that it was sufficiently safe to do so. And so were they obligated to go claim that Bcash fork that day? Right. And so I can come back and talk a little bit more about how Wyoming split some of these hairs in a very fair way. But the bigger point is, we're seeing litigation now. And this is one of the things that as I was looking through this lawsuit draft was, oh my gosh, the judges have no idea how to adjudicate these disputes. The big dispute is, what is Bitcoin? What law applies? And then the next dispute is, whose state law applies? In that case, it was a dispute between California and Delaware. And I was shaking my head thinking, God, if the intermediary had been in Wyoming, these issues just wouldn't be there, because the judges have a clear roadmap to adjudicate the disputes in a way that respects how the Bitcoin protocol actually works. And so, right. And that's the risk, is that you get these judges who don't understand Bitcoin, and some weird outcomes are going to have an impact, and that might impact you whether you like it or not. None of us live in societies where laws don't apply, and so if there's an adverse judgment that might impact you indirectly, you want to be careful. You want to avoid those kinds of things. There was a teach-in for the judges in Wyoming that one of the people that participated told me about last week. And one of the judges said he already had a Bitcoin litigation, a Bitcoin case in front of him in his courtroom in Wyoming. And it had to do with somebody, I don't know if it was a divorce or something, but delivering the Bitcoin as part of a settlement, and the person involved convinced the judge that Bitcoin could not be converted into US dollars. And one of the professors who was involved in this quickly jumped in and said, "You were lied to." So anyway, long story short, this is in the courts right now is the Wild West, and we're going to get some really crazy judgments coming out of lawsuits. And all this is going to get settled over the next few years. But right now, we got to be careful about all of it. And that's indeed one of the things that we're trying to do in Wyoming, is get ahead of all this so that Bitcoiners don't end up on the short end of the stick.
I think that's a great point. I lost you for 15 seconds there, but I get the primary point you're saying. And I'm wondering, because there's the hardcore Bitcoiners that are not your keys, not your coins, anonymize your coins, the whole 9 yards. And then you've got, let's say, exposure Bitcoin. And this is the white label. This is the ETFs. This is the legacy markets and participants and investors coming in, using custodians, using products, and getting exposure to Bitcoin price action. And, what I take from what you're saying is that it's important to try to make the requisite changes in the legal framework to respect the very novel characteristics that Bitcoin represents, and try to move them over to the framework that everyone's used to operating within. And that's awesome. And I think that's good because it permits a better way for the legacy people to interact with the attributes of this thing.
Yep.
Are they not at the same time fundamentally opposed? Like, do you think, could you, I mean, what do you think is the tension between the two, and how do you think that will be played out?
Well, I mean, if you want to have fiat currency on and off ramps into digital assets, which I obviously happen to think is important. And that's because you've got to be able to get into the digital asset system. I recognize that more people are coming in than are going out, but there are a lot of people who are trading, and that's creating liquidity, and that's good. And they're going back and forth between Bitcoin and dollars all the time. That's good. So how do you actually, are those two things fundamentally incompatible? No, but you've got to be careful how you build the bridges, because the assets themselves are fundamentally incompatible in their settlement characteristics. Again, we're coming back to settlement. Bitcoin settles in 10 minutes. I mean, instantly when you see the Bitcoin, it arrives, but it's not considered settlement until you get that first confirmation. And some would argue not until you get the sixth confirmation, but it settles in minutes on the blockchain with transparency. And here's the other key. It settles with irreversibility. US dollars don't settle with irreversibility. And they don't settle in minutes. Okay. So it's the speed of settlement and it's the finality of settlement that are very different between Bitcoin and the US dollar. This is where I'm hyper focused. How do you make sure that Bitcoin itself is not causing systemic risk within the US dollar payment system? And how do you make sure that intermediaries don't get caught up in this very issue? By the way, this is the reason why most of the Bitcoin exchanges will not allow you to take your Bitcoin off the platform for typically 10 to 14 days after you buy it. Because if you send $1 to buy Bitcoin at, Coinbase, for example, and you send that dollar through ACH, and then Coinbase sells you the fraction of a Bitcoin, and then you turn around and go to your bank and say, I didn't send that ACH payment, the bank is going to have to reverse it. So now all of a sudden, if Coinbase has allowed you to take the Bitcoin off the platform and you reverse your ACH payment, guess what? Coinbase is the one out both sides of that trade. Okay, that's a huge risk issue. Again, it's all about settlement. That's a huge risk issue. And so this is the reason why, for the most part, for consumers, you can't take your coins off platform for typically a couple of weeks, because most of the reversals and the fraud is discovered in those first few days. And that's the way the consumer laws work under the ACH system. And the ACH, it's called Automated Clearinghouse, is actually proposing to extend the period for fraud to 2 years. So if there's fraud, then the consumer can report it to the bank, and the ACH payment can be reversed up to 2 years later. How do you square that circle where Bitcoin settles in minutes with irreversibility and your dollar might not actually settle with finality for 2 years?
See, this is in my hyper Bitcoin bull mind, and perhaps longer term projection. This is the outcome, or this is the process of the immutable qualities of Bitcoin reshaping everything downstream of it. So like this is very, very early days, right? All we're trying to do effectively now is try to get Bitcoin to fit into this, or at least that's the narrative, right? Yeah. But I actually think what's happening and what's going to happen is Bitcoin is going to impose its structure, its immutable characteristics on our existing legal framework. And obviously this is going to take some time, but it's going to distill it down to an entity that maximally optimizes the qualities that Bitcoin has with whatever relationship of governance we deem is necessary to add on to that.
That's right. And so there are 4 characteristics of that entity that can safely plug Bitcoin into the US dollar financial system. Number 1, very importantly, it's not leveraged. Leverage and Bitcoin do not mix. We can come back and talk about that in a minute, but I can't underscore that enough. Leverage and Bitcoin do not mix. Number 2, the entity holds 100% cash for the assets backing the customer deposit liabilities. If it's a bank, for example, where they're accepting US dollar for payment, and then Bitcoin is provided as a trust department service for custody, those two things the deposits are on balance sheet, the Bitcoin's off balance sheet. Okay, so that bank should not be leveraged, and it should hold just cash on its balance sheet. Very simple balance sheet. Left-hand side, cash, right-hand side, customer deposits, and common equity. Very simple. The next piece is that trades should be pre-funded. It's what you're talking about. You should not allow this settlement risk to pile up, because you can end up with indirect leverage exposures as a result of that. And now I'm blanking on what the fourth one was. Actually, hang on. I actually have some notes here. I'm just having a brain fart on what that is. Sorry. Oh, ring fenced is the other one. I was very public and critical of State Street when it came out about a month ago that State Street is providing bilateral credit lines to its institutional trading customers to trade Bitcoin as if it were any other currency, because that is not ring fenced from what is one of the most systemically important institutions in the world. And all of a sudden, to your point, if their systems are not updating every minute and they're only updating overnight, you could see a systemically important bank very innocently end up with a leverage exposure in Bitcoin and not even know it. Again, so those four things: don't leverage it, don't hold anything but cash in the fiat side of the institution, ring fence it, and then make sure all the trades are pre-funded or at least simultaneously settled between Bitcoin and dollars. That's how you do it. By the way, I just described to you the philosophy behind the Wyoming SPDI charter. That's exactly how Wyoming built the SPDI charter. We did not want any indirect leakage of settlement risk to come into the US dollar payment system, precisely because Bitcoin can cause problems if you treat it like it's just any other financial asset. And it does look, unfortunately, like some of the big banks are looking at it that way. And I cannot warn financial regulators loud enough: don't look at it that way. Traditional VAR models, value at risk models, don't apply. There is no clearinghouse. There is no lender of last resort who can paper over a temporary settlement failure in Bitcoin. And, a lot of people would say that's a feature, not a bug. I just say it is. It's just the way it works. The real clearinghouses in Bitcoin, in the event there's ever a problem at one of the big intermediaries, are the whales. That's it. And the reason is that 75 to 80% of coins are owned by individuals and not held at custodians. And I just saw an interesting article within the last week that during bull markets, there's a big withdrawal of coins off custody platforms. And we're now down to about 12% of the Bitcoins outstanding are on custody platforms, and the rest are held by individuals off intermediary, self-custody. So there's going to be a perpetual shortage of collateral. So if you want to think about applying the Wall Street trading approach to Bitcoin, you're never going to be able to find collateral if you let these exposures get too big, and if you're not hyper careful to lock down all of the risk. And that's the responsible way to do it. Most of the intermediaries in Bitcoin operate that way already, but I'm sure a lot of you are listening going, maybe some of my intermediaries don't. Be careful. This is why the not your keys, not your coins matters a lot. And 75 to 80% of Bitcoin is heeding that warning. Now it looks like it's closer to 88% heeding that warning and have pulled coins off intermediaries. And that's the right way to do it. You want to be the legal owner of your Bitcoin, not your keys, not your coins.
Yeah. And I think that's, exactly the point I was making before, is that at the moment, it might seem that Bitcoin is imposing a form of discipline on the operations of typical standard practices, let's say. And I think that's the drip, the imposing of the discipline. And then it, almost in an attempt to control it, you have to make yourself flexible enough to accommodate its unique attributes and how it actually works. And if you do that for long enough, you kind of become it. You become something similar to it, right? In trying to accommodate it.
Yeah. It's interesting. A friend of mine, one of my mentors, reached out to me when Square first invested 2% of corporate cash into Bitcoin. And he said, Bitcoin's going to hack big tech. Big tech thinks that they're going to get control of Bitcoin, but Bitcoin's going to hack big tech, and he's right.
Bitcoin's
And
going to
that's
hack
the exact
everything.
same point that you're just making. They want to be the centralized control. They want to be able to censor, and they want all of our data. They want us to have no privacy whatsoever, and they just want to sell stuff to us. But in fact, actually, Bitcoin's going to hack them. They will never control it.
It's a beautiful thing. It's a beautiful thing. Before I want to talk about Wyoming rather, and Avanti, but you mentioned leverage, rehypothecation, lending.
Mm-hmm.
It's an aspect of all this that's growing. More institutions and places are offering these services. Why is it you think that's a bad idea or it's a dangerous idea? Can you elaborate on that?
Well, hypothecation is fine. It's rehypothecation that's not. Okay, so borrowing against your Bitcoin, a lot of people are going to do that in order to avoid having to pay capital gains taxes, or just defer, rather, is the better way to say that. You can get some liquidity for your asset by borrowing against it, and therefore you don't have to sell your Bitcoin and pay taxes on it. And so that is a strategy I'm aware a lot of people are using. That's a legitimate strategy as long as you never go above 100% of the value.
Can I stop you for 1 second and just ask you a question? When you do that, and let's say you do it in the best possible instantiation, which would be you hold a key and then the lender holds a key and then someone else holds a key or something like that.
Yeah, you're never going to get them to agree to that.
Yeah, well, aren't we just back to who has the property right to it again?
Absolutely. Yes, this is why I'm not recommending this, to be clear. I don't do this myself. I know I have a lot of friends who do. And it's because they're more focused on, deferring taxes and don't want to have to sell their Bitcoin, but want some liquidity against that asset. That's the same thing as margin accounts for stocks. It's a legitimate strategy, but it's not one I recommend because
it's back to the old way of doing things.
Yeah,
right?
and I also like the way Andreas puts it. Maybe if you deposit your Bitcoin into a lending firm, maybe you'll get 6% interest, but it's 6% interest today, 90% losses tomorrow. And you'll never get those Bitcoins back, right? If the intermediary goes bust. It didn't make much news, but the Cred bankruptcy should have been a shot across the bow to a lot of players in this industry. Cred, it came out, was running fractional for months before they finally hit the wall. And they were playing with your Bitcoins behind the scenes. And there's one of the things I've also said is there's no counterparty credit risk disclosure, not even in the OTC markets. There's still just a lot of trust. People are because there haven't been defaults in the OTC markets yet. People are assuming that there won't be. Trust me, there will be. It's something called Herstatt risk. Herstatt was the German bank in a foreign exchange transaction that went down and caused a ripple domino effect in foreign exchange markets. That's going to happen again in Bitcoin. And I say good riddance when it does happen. As Warren Buffett likes to say, when the tide goes out, you see who's swimming naked. Well, the tide's still coming in right now. We're in a bull market. And Cred failed in a bull market. That should tell you something. But one of the things that I think you should watch is when you roll the dice with intermediaries like this and try to get yield on an asset that's not supposed to be delivering yield, you don't know if that 6% is remotely compensating you for the counterparty credit risk or not. Sure, it looks much better than what you get on your dollars that you're deposited at your bank right now. But as Andreas says so well, up 6% today, down 90% tomorrow. Yeah. And you don't know that you're not in that category. So just, beware, be very, very, very careful.
And the same is true for, these lending services, right? You post Bitcoin collateral and you get cash, but what you've done is you've swapped a primary claim on your Bitcoin for a primary claim on the cash in the hopes that intermediary will grant you back that claim at some point in the future.
And we'll deliver it back to you. Yeah.
Right.
Well, and one of the surefire signs that financial intermediaries are getting into trouble is if they keep raising capital. I'll leave you with that thought.
Sneaky. I know what you're saying. But so we got 8 minutes left. I know you have a hard stop. This is my last two questions. It's been, and I love your commentary. I've heard you from podcasts on the broader, all that kind of stuff, but that will probably have to wait for another time. But I'll just use that to say that this is causing a lot of people around the States, around the world, to look for places that prioritize individual liberty, broadly speaking, because that's been imposed and infringed upon in many places around the world today. And Wyoming is amongst the small group of, for lack of a better term, red states that seems to, at least in relation to a lot of these other jurisdictions, prioritize those ideals. And so I think there's, Texas and Florida are the two ones that get mentioned the most, but there's a lot of people coming to these jurisdictions for those reasons. And then you layer on top of that the very forward, thinking regulations around Bitcoin that I know you've been instrumental in. And it starts to become a very, attractive place for a lot of people if they're looking at getting out of places that, have a lot more overbearing regulations, let's say, of various kinds, and government involvement in people's lives, to a place like Wyoming. So first question is, what's going on in Wyoming these days? Is there a big influx of people, and why should people look at Wyoming as a place to relocate? And then use up the whatever time remains to tell me about, I know you had a big raise at Avanti a couple months ago, I think 37 million, if I'm not mistaken. What's focus one for you guys at Avanti, and what's going on? I know it's a big question, so take it, use up the time that you have.
I'll start with what's going on in Wyoming. We've now, in our fourth legislative session, which just concluded a couple weeks ago, we're now up to 24 blockchain laws in 4 legislative sessions that have been enacted by the state of Wyoming. This year, the big one was recognizing DAOs, decentralized autonomous organizations. A lot of the Bitcoiners are like, wait a minute, that's an Ethereum thing. Not really. There can be Bitcoin versions of that too. We have smart contracts through some of the layer 2 technologies, like Liquid, for example. So absolutely, those laws are potentially beneficial to Bitcoin. And what that is a limited liability company. So in other words, you lock down the risk that you become what's called a general severally liable with everyone else in the project. Now you get some limited liability, just like a corporation or a limited liability company would get, and those and that's an important risk factor that everybody should be locking down. But by the way, I must say that bill caused people's imaginations to just go crazy. The crush of people that contacted me on that transaction on that announcement was insane. I'm getting absolutely crushed. I apologize. A lot of you are contacting me and I can't even respond. I'm so sorry. But I'm getting about 50 requests for my time every day. I'm very, very focused on Avanti. So I'm just prioritizing all the Avanti specific stuff. And we're very internally focused, preparing for launch. But to answer your question, have a lot of people moved to Wyoming? Yeah, but even more people domiciled their businesses here. And Wyoming's fine with that. This was definitely about bringing jobs to Wyoming, but it's also about getting the fees from companies domiciling here. Boy, there's been a huge crush of people domiciling their businesses in Wyoming, and this DAO thing is definitely going to be a big deal. So you don't have to move here to get the benefits. And if you decide that you do want to deal with an intermediary, and there are certain groups who have to, I'm not recommending it, but there are certain groups who have to deal with an intermediary, namely an investment manager. By law, the asset manager has to segregate custody of the assets from the management of the assets. And so if you are required to find a custodian, why wouldn't you use a Wyoming custodian for your Bitcoin? That's going to be a question I think a lot of people are going to start asking once the Wyoming Bitcoin custody banks are up and running. Now that's coming later this year. It's definitely coming. Both Kraken and Avanti are already approved. There was a third company that went through its banking board charter hearing yesterday. There's a fourth one. I understand that the hearing is going to be in June. None of us are through the Federal Reserve yet, which is so this is the reason why we're not open yet. Lots of folks are asking, when are you open? And by the way, in Avanti's case, we're only doing business with business customers, especially at first. The compliance requirements are just so much higher to deal with consumers. Kraken, of course, is dealing with consumers. So between Kraken and Avanti, we should be able to cover the gamut. In terms of Avanti, we have not announced a date for opening yet. We're still working through things with the Federal Reserve, and we're getting all of our ducks in a row. One other thing about being a bank that has access to the payment system is, oh my, are the compliance requirements high? You can't just build your own system. You have to go through very, 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 very detailed regulatory compliance and IT requirements in order to be bestowed the benefit of getting access to the US dollar payment system. It is a privilege. It is a very high bar. And oh boy, is it a lot of work. It's more work than even I anticipated. And I knew it was going to be a lot of work going in. Brian Bishop is a Bitcoin Core developer. He's our CTO. He will also be in Miami, by the way, as well as Daniel O'Donnell, our head of business development. So there'll be 3 of us at the Miami conference, and we hope to see you there.
Well, Caitlin, we'll have to do a part 2 sometime, because I got a ton more stuff for you about all the stuff we talked about and more, but I know you're super busy. I know you've got a lot on your plate. You've been working really hard at this. So congratulations for the success that you guys have been met with so far. And I'm sure it'll continue. I really look forward to hooking up at the conference. Any last words before I let you get back to your day?
Hodl on. This is fun. Bull markets are fun, but just remember, you're a real Bitcoiner if you agree with the following. This is not about price. This is about so much more than that. I love how Jake Chertivsky put it. We get more sleep during bear markets. That's when the real work gets done, because things get crazy during the bull markets, and we're in the crazy phase right now. But it's fun if you pay attention to such things. Enjoy it. It's certainly fun to see number go up.
Yeah, I think it's going to be a very interesting rest of the year. So we shall see. Anyways, Caitlin, thanks so much. Take care, and we'll see you soon down in Miami.
Yep, indeed.